Bond markets get jittery as the Fed meets. Welcome to Market Insight. I'm Elena Casas. There's little doubt in the markets that the Federal Reserve is due to cut another quarter point off rates tomorrow, but futures markets now see maybe just 2 cuts next year, and policymakers' estimate of the long-term neutral rate moving higher, perhaps above 3%. That sent 10-year Treasury yields rising again this morning. Well, for more on this, I'm joined now by Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. Jeff, hello. What are the bond markets telling us then? They clearly now expect relatively little rate movement in 2025.
Well, I think the bond markets are waking up to the realization that the Fed is going to do less than what's anticipated, given the economic resilience that you've seen in the U.S. You got a retail sales number today that definitely confirms that the consumer is locked in and a workhorse of this economic backdrop. And although we will get a 25 basis point rate cut tomorrow, given the jobs report that we saw in November and a relatively benign inflation print, we're not sure how much follow through we're going to see in 2025, especially with some of the uncertainties that we're going to get from a policy perspective. So with the markets pricing in 2 additional cuts in 2025, that feels about right to me, but I would say the bias is probably to the downside of 1 cut rather than the upside of 3 cuts. And the 10-year Treasury is reflecting that today.
How hawkish do you think policymakers might be in their commentary tomorrow?
I don't think they're going to be hawkish. I think they're going to be data dependent. They're going to, vocalize that the economy has held up very well. There's a lot of uncertainty ahead, and that pace of rate cuts is likely going to be coming down as we move through the first half of 2025. So I think it's going to be a relatively straightforward press conference for Jerome Powell. But ultimately, we've already had 100 basis points worth of rate cuts, which is more than what we saw in the 1995 and 1998 soft landing rate cutting cycle. So there's already been a lot of accommodation, and the Fed needs to be a little bit more nimble to find out where neutral exactly is.
Jeff, US markets have widely outpaced international counterparts in 2024, as has the dollar, of course. Can this continue, do you think?
I do think that it will continue. I think the dollar will continue to strengthen in the first half of 2025. You're going to have a strong U.S. economy. You have expectations for more fiscal stimulus as you move to the back end of the year, and that's going to attract more capital and strengthen the dollar. If you're going to get less rate cuts, again, that interest rate differential should widen. Again, another support for the dollar. And historically, tariffs have strengthened the dollar, as a lot of countries that experience tariffs tend to depreciate their currency to be able to blunt the effects of tariffs ultimately. So I do see a resilient dollar, at least in the first half of the year. And as far as the markets are concerned, yes, there's a lot of expectations that are embedded in U.S. equities, but I think U.S. equities will continue to deliver strong returns relative to the developed world ex-U.S. and emerging markets, with a lot of the rest of the globe slowing and tariffs likely going to provide a headwind to their overall performance. So while the U.S. has outperformed in 2024, I continue to see that happening in 2025.
You mentioned tariffs there. Of course, as you mentioned, the policy outlook from the new administration is uncertain, and tomorrow Chair Powell is likely to refuse to discuss any specifics. But clearly the Fed has to take this into account when they forecast inflation. Just how much do you think they're likely to predict that would be inflationary?
Well, it's hard to say. One could view tariffs as like a tax. It's going to be a one-time increase of prices, ultimately taking away the purchasing power of consumers, which would lead to lower growth down the road. Or the Fed being behind the curve with the increase of inflation that we saw in 2022 and 2023, may be a little skittish that inflation expectations could rise to the upside if tariffs move forward. Now, ultimately, Powell is not going to talk about that tomorrow because we need to see what happens when Trump moves into the Oval Office. But ultimately, I think that the Fed will view this as a one-time increase of prices rather than a sustained increase of prices, which is what you usually see with aggregate demand that's too elevated. And given the progress that we've seen in the labor market and the slowdown in wage growth, it doesn't appear that aggregate demand is outstripping supply by a wide margin at this point.
What about that fiscal stimulus that you mentioned, such as large tax cuts having an impact on the federal deficit? The premium the market demands to hold longer-term government debt has been rising. So is there some nervousness about that?
I think there is a little bit of skittishness, but if you look at the 10-year Treasury, when Trump was elected and you had a red sweep scenario, the 10-year Treasury did back down lower in the aftermath of the election results. So I think the 10-year Treasury rising today is on the back of less rate cuts that are going to be anticipated by the Fed, a higher neutral rate, and maybe a more resilient economic backdrop rather than concerns about a bigger deficit. And as long as the U.S. economy continues to outperform its global peers, I think you're going to continue to see 10-year Treasuries remain range-bound in 2025.
Jeff Schulze of ClearBridge Investments, thank you so much for joining us. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.